Investing in the stock market is no mean feat. A key factor in this venture is knowing which stock to choose and which ones to avoid. Selecting the best stocks out there is not a game of eeny meeny miny mo, but rather a step that requires knowledge and experience. Well, you are in for a treat because for today's video, we'll explore 5 dividend stocks that will consistently put $500 or more into your pocket each month. Dividend investing can be a powerful way to generate passive income, and we're about to reveal some of our top picks. This is Foxfire Finance, and we're committed to spreading the great news and concepts of the FIRE movement to anyone dreaming of a better life. We aim to help you achieve your goals by providing meaningful tips and strategies that will bring you closer to your dreams of financial independence and retiring early. But first, don't forget to subscribe, burn that like button, and ring the notification bell to be updated on our latest releases to guide you on your way to FIRE. Are you ready to learn more? Introduction: the power of dividend stocks. Dividend stocks are like the gift that keeps on giving in the world of investing. But why are they so beloved by investors like you and me? Well, it's all about that reliable stream of income. You see, when you invest in dividend stocks, you become a shareholder in a company. And guess what? Companies love sharing their profits for their shareholders, which means they pay out a portion of their earnings as dividends. This steady income stream is like a financial safety net. It's not just a one-time cash infusion. It keeps coming in regularly, typically every quarter. That's why dividend stocks are a top choice for long-term investors looking to build wealth over time. But there's more to it than just the income. Dividend stocks often belong to well-established companies with a history of financial stability. That means you're not just getting paid, you're investing in businesses that have stood the test of time. So when we talk about our favorite dividend stocks, we're not just talking about investments, we're talking about reliable financial companions that can help you reach your long-term financial goals. And now, it's time to take a closer look at our 5 dividend stocks that consistently deliver. Stock number 1, JP Morgan Chase. Let's delve into the first gem in my dividend stock portfolio, the financial juggernaut JP Morgan Chase. This financial giant is renowned for its generous dividend payouts, currently offering a solid 3.4 to 3.5% dividend yield on its stock. In simpler terms, for each share of JP Morgan that you own, you can expect around $4 in annual dividends. While a 3.5% yield may not sound incredibly high, it's important to note that it surpasses the S&P 500's benchmark average of approximately 1.7%. Dividend yields across the board have declined since my initial foray into investing, primarily due to rising share prices. As share prices climb while dividends remain constant, the yield naturally decreases. What sets JP Morgan apart is its rock-solid financial position. With a staggering $1.7 trillion in liquid assets, of which over $700 billion are in cash, JP Morgan provides shareholders with a strong sense of security. It's highly unlikely that a company with such deep pockets will face financial hardship. Moreover, JP Morgan is strategically positioned within the financial sector, particularly with the looming prospect of rising interest rates. As the Federal Reserve gears up to increase rates, banks like JP Morgan stand to benefit, profiting from the interest rate differential they can exploit. This bodes well for JP Morgan's net interest income, which is expected to climb throughout the year and beyond as the Fed tackles inflation. Security is paramount because a company that goes under won't be paying dividends. Thankfully, JP Morgan demonstrated its resilience during the 2008 financial crisis, unlike some of its counterparts. With its substantial cash reserves, JP Morgan is here to stay, making it a cornerstone for the portfolios of its shareholders. Stock number 2, Abbvie Inc. Let's take a closer look at the next contender, Abbvie. Abbvie is a biopharmaceutical company with an impressive range of drugs spanning various sectors, including oncology, immunology, and neuroscience. Currently, the stock boasts a 3.95% dividend yield, equating to approximately 5.64 cents per share annually. Well, Abbvie might not ring a bell, but chances are you've come across a commercial for their flagship drug, Humira. This remarkable medication alleviates pain and swelling associated with conditions like arthritis, rheumatoid arthritis, Crohn's disease, and various skin disorders. In fact, Humira consistently ranks as one of the best-selling drugs globally, with 2019 sales surpassing a staggering $19 billion. Let's acknowledge that investing in a pharmaceutical company can be seen as controversial given the complexities of the American healthcare system. However, Abbvie's strong market position, driven by leading patents and ongoing investments in research and development, diversifies their product lineup. This strategy fortifies their economic standing, bolstered by a substantial operating cash flow of $22.9 billion annually. Including Abbvie in your portfolio provides essential diversity among your holdings. While Abbvie faces the challenge of Humira losing exclusivity in 2023, potentially increasing competition, their robust commitment to R&D could mitigate its impact. At 5.64 cents per share, the dividends add up, making it an attractive option. If you own 100 shares of Abbvie, you'd receive a noteworthy $564 annually. Stock number 3, PepsiCo. The third stock on our list is a household name we're all familiar with, PepsiCo. PepsiCo not only brings us our favorite soft drinks, but also boasts ownership of Gatorade and Frito-Lay, the company behind those beloved potato chips. Currently, their dividend sits at a comfortable $4.6 for every share you own, translating to approximately $1.15 every quarter. This results in a 2.73% dividend yield, which is quite comparable to JP Morgan. It's a fair question given Coke's reputation. However, let's lean a bit more towards Pepsi because of its diversified product range. While Coke primarily sells beverages, Pepsi deals in consumer packaged goods like chips, which account for around 20% of their revenue. This diversification offers growth opportunities in various segments. Pepsi also enjoys pricing power as consumers consistently demand their products, even in the face of modest price increases. In the current inflationary environment, if they can manage to pass on some of those increased costs to consumers without causing a fuss, it's a significant win. Pepsi's longevity is another reason it's a solid choice. It's been a staple in our lives for generations, and its size and product demand ensure it's here to stay. So, when you're investing in Pepsi, you're investing in a company with a rich history and a promising future. That's a big sign of stability, don't you think? Moving on, let's go to stock number 4, Kraft Heinz Co. This company is another well-known brand, Kraft Heinz Co. You've probably encountered Kraft Heinz before, as they're the folks behind all those beloved condiments and kitchen staples like ketchup, mustard, mayonnaise, and A1 steak sauce. They're not just making these products, they're selling them in vast quantities, with net sales reaching a whopping $26 billion last year. Kraft Heinz boasts a robust dividend with a 4.62% yield, amounting to around $1.6 per share you own. Despite trading relatively flat for the year, this stability is a reassuring contrast to the S&P 500's 17% dip. It's also worth noting that this stock remains a fixture in Warren Buffett's portfolio, which speaks to its enduring appeal. Investing in a company centered around consumer food staples is a smart move. Food is a constant necessity, and even in challenging economic times, people need to eat. So the demand for Kraft Heinz's products is likely to persist. However, it's prudent to keep a closer eye on Kraft Heinz Co. In recent years, their profits have shown a slight downward trend, albeit not a significant one. This could be linked to the shift towards healthier eating and a move away from packaged and processing goods. While their dividend is not overly concerning, it is best to monitor their financial performance closely in the coming quarters. If things don't improve, a reallocation could be considered in the future. And finally, let's go to our stock number 5, Johnson & Johnson. Now let's wrap up our list with Johnson & Johnson, a stock that continues to hold its place in Warren Buffett's portfolio for very good reasons. They offer a solid dividend yield of 2.7%, putting them on par with JP Morgan Chase. This translates to around $4.52 per share annually. Johnson & Johnson is a prime example of a stable company with enduring appeal, thanks to its remarkable lineup of brands including Tylenol, Listerine, Band-Aid, Pepsid, Vino, and Zyrtec. What sets them apart is their resilience to economic downturns. Whether we're in a recession, facing inflation, or dealing with high interest rates, doctors continue to prescribe Johnson & Johnson products to their patients. Another feather in their cap is their status as a dividend aristocrat, having consistently paid dividends to shareholders for over 50 years. Not only have they maintained this track record, they've also consistently increased their dividends. Johnson & Johnson embodies the essence of a value stock that thrives in various economic environments. They've even outperformed the S&P 500 this year with a 1% gain. With a substantial cash reserves and minimal short-term debt, they're well prepared even during the most challenging economic conditions. In essence, Johnson & Johnson is a dependable choice in your dividend portfolio, just like the other safe and reliable picks we've explored today. So that's a wrap for today's video. Investing in dividend stocks can be a lucrative endeavor, and we hope this video has provided you with valuable insights. If this guide lit the spark for your wealth journey, then burn that like button and don't forget to subscribe to our channel for more tips on how you can reach your financial goals. Until next time, we are Foxfire Finance, and keep that fire burning.